Everyone, Weston Nakamura from Real Vision in Tokyo. So the yen, which was the worst performing major currency versus the dollar in the first half of this year, was plummeting almost 20% at its lows to multi-decade lows, or dollar yen at multi-decade highs. The yen has sharply reversed course and is currently surging, or dollar yen collapsing, pretty much one directionally. It's down about 3.5% in the last 3 or so trading days ever since July of FOMC. And the yen isn't just rallying versus the dollar. Since last week's FOMC, the yen is up over 2% versus the euro, versus the British pound, versus Aussie dollar, and various other, G5 currencies. And no, this is not dollar weakness, because yes, the euro dollar cross rate is up about 1.25% over the same period since FOMC, but the yen is up more than double that. So when it comes to the yen, this isn't the dollar weakness story. This is hand over fist yen buying or yen short covering and frantic position closing underway as we speak at the time of this recording, which is Monday, August 1st, after Japan market close, for the sharpest 2-day rally in the yen since the tumultuous days of March 2020. And this is currently the longest win streak on consecutive days since February of that year as well. Okay, so why is this happening? And ultimately, why should you care, right? Well, in this video, I'll tell you why this is happening and where I think we're going to go from here. But first, let me answer the latter question. Why should you care if you're not personally directly exposed to this stupid currency like I am? Few reasons, but let me focus on 2 key reasons. Number 1, shorting the yen has been the Fed trade, if not the global macro trade of 2022. Okay, and as such, shorting the yen, or being long dollar yen, is thereby an incredibly crowded trade, almost one-sided. So when one of the most crowded trades in global macro is suddenly reversing course and people are rushing for the exits, I don't care what the trade is. You need to pay attention to it, right? And then number 2, the yen has direct and indirect implications on various other asset classes, namely sovereign yields, such as U.S. Treasuries. And if yields, rising or falling, are driving risk assets in price direction, up or down, then the yen is certainly worth paying attention to for that reason. Okay? So, when I say that the yen is a Fed trade, I had this discussion on the eve of the FOMC last week with Andreas, and we actually discussed this very thing, and I actually put out even a trade call, a trade idea out there, if you will, to be long the yen going into FOMC.
Sending to you live the 26th of July ahead of the extremely important decision from the Federal Reserve tomorrow. And with me today is an avid central bank follower and also a senior markets editor at Real Vision as well, Weston Nakamura.
The reason I'm watching the yen is because shorting the yen has been the global macro trade of 2022, or at the very least, short yen or long dollar yen has been a Fed trade, if not the Fed trade. The reason is because normally rates traders would bet on like front end rates, usually using euro dollar futures. Just note, those who are unfamiliar, euro dollar futures are short-term interest rate derivatives, not to be mistaken with the euro. This is not a currency instrument, it's completely different. So normally rates traders, they would bet on where they expect Fed funds will be priced and at what level and when, et cetera, right? If you take a look at these 2 charts that I have, the top chart is implied volatility on euro dollar futures. Bottom chart is just the price of yen futures. So for the past several years, both euro dollar implied volatility and the yen have been relatively flat. Then starting around 2021, and then really ramping up in 2022, we have implied vol on euro dollar futures skyrocketing to insane levels. And that surge in front end rate vol is a direct reflection of Fed policy uncertainty. Like if you wanted to quantify and chart out market uncertainty of Fed policy, that's what that chart would look like, right? So rather than traditional outright bet on Fed policy, traders instead have been playing a relative trade, hawkish central banks against the lone dovish central banks, which is obviously the BOJ and the JGB market. And you can see those kind of splitting off in tandem. And so this policy divergence trade, or shorting the yen, this is a massively crowded trade. So this is asset managers' largest net short CME yen futures position on near record. Now, regarding the shift of markets positioning from inflation shifting to recession, I also mentioned this in the BOJ video, but first of all, in my view, at this moment, there is nobody who wants an overly hawkish Fed to break things more than BOJ Governor Kuroda. Because although the Fed and BOJ policy divergence is what's been killing the yen and causing Kuroda all these headaches, at this point, Kuroda's best scenario would be for the Fed to hike and to suffocate the economy and break things, and then get a bid back into bonds. JGB yields come down on their own without central bank intervention. Dollar yen comes down, and Kuroda, who's been on hold this whole time, looks like some sort of like hero as markets, the economy came back to him, right? And this is also what he's kind of betting on staunchly by defending yield curve control. Like, he needs a recession before his term ends in April 2023. And then as of late, markets have continued to shift from inflation to recession concerns. I'm repricing, particularly in Europe, the Euro Swissy rate, just broke through that one level to like the 99 handles. And now it's, hitting record lows even today. So basically, if the FOMC and Powell, if they aren't as hawkish as expected or as priced in, we can potentially see a rush to close these short yen positions on this US to Japan policy divergence profit taking. And so the play for me is to short the euro. So you short EU or JPY because the euro remains relatively strong versus the yen. It's been getting killed by everything else, but versus the yen, it's still pretty buoyant. But it is topping out with this recent ECB's TPI, as I call yield spread control, makes ECB more in line with BOJ's yield curve control than with the Fed, even with ECB's front-loaded rate hike. So that policy divergence between the ECB and the BOJ, that needs to close up via Euro JPY. So that's how I'm looking at it.
If we look at the yen trade, I have to admit that I perfectly agree with it. I have to trade on myself because of the risk reward of the trade. If we look at a couple of scenarios, if the Federal Reserve is extremely hawkish, there is a potential risk that they break equity markets into the autumn. I think that's ultimately a good thing for the yen if the Fed really manages to break assets in a violent fashion. But if they surprise on the dovish side, then I also think that we should expect a rally in the yen as a consequence of the positioning that you just depicted. So it is an extremely good risk-reward trade, given that it kind of works in both the extreme dovish scenario and in the extreme hawkish scenario from the Fed.
Let's take a look at what's actually been moving spot dollar yen since June FOMC and June BOJ. Okay. What's moving spot dollar yen by and large, especially in these like very sharp moves, both to the upside and the downside, it's yen listed derivatives or CME futures and options. Okay. Which basically get triggered by fundamental macro catalysts as well as simply by price action momentum. So June FOMC and June BOJ, if you recall, was an absolutely insane week. It was the most insane week year to date, and this was not exactly a sanguine year to date either. But that's the week that preceding that week we had the Wall Street Journal leak of the imminent 75 basis point FOMC hike that was coming later that week. That the Fed basically, held an unofficial intra-meeting rate hike via the Wall Street Journal that weekend. And then that put a ton of sell pressure on global DM bond markets at Monday Asia Open. And the BOJ then let JGB yields slip out of their hands and break above the 25 basis point yield curve control level to 30 basis points. And that created a ton of havoc and all hell broke loose, right? You saw Treasury yields absolutely surge to their year highs. You saw, volatility explode cross asset. You saw equity markets had their worst day since March 2020. Crypto was down like double digits intraday, and so on and so forth, right? In other words, the very scenario that I had been warning about with BOJ this entire year, and why you need to pay attention to BOJ, because if they let yield curve control slip out of their hands, or if they, adjust it or move it, it's going to impact everything, right? like whether or not, global markets are knowingly or otherwise addicted to the Bank of Japan capping global yields indirectly with yield curve control. And that week when foreigners sold, a record amount of JGBs and BOJ bought a record amount of JGBs as the Widowmaker trade piled in. And, we saw yen futures surge and then plummet and crazy volatility as markets had their most sort of hardcore bare knuckle fist fight with, the Bank of Japan, or really with any major central bank in recent memory. That was that week. Okay, so June FOMC, June BOJ, very insane week. It wasn't too long ago. So let's take a look at this chart. Okay, this is just a simple chart of yen futures on CME and yen futures trading volume on the bottom, and I've also overlaid spot dollar yen in blue shaded area on top for reference. But note that I'm not looking at that spot dollar yen USD JPY level. Yes, obviously I'm looking at I know where the rate is, where the currency is trading, but in terms of looking at it from an analysis, from a market price action analysis standpoint, I'm not looking at spot dollar yen because that's not the driver. That's being driven by futures and options on yen. And you can just simply look at this chart and you can tell, right? Look at the price action, the sharp movements and the corresponding trading volume spikes, both to the upside and the downside, that are happening throughout this period. So what happens is, because the yen's a Fed trade, or a Fed BOJ policy divergence or convergence trade, or an inflation versus recession trade, anytime you get some sort of major market moving macro data related to any of that, or if certain price levels with a ton of options open interests are breached, then you get huge sudden moves in yen futures, which corresponds to sharp stair-step movements in spot dollar yen. Okay, so here's June FOMC, and then here's June BOJ. Okay, yen futures up and then crash back down. Yen futures at the 75 price level. Okay, 0.0075, but I'm not gonna say all the 0.00s. Call it 75, right? 75 was the level for yen futures when all that insanity was going on with BOJ and FOMC from June. Just keep that in mind. Okay, I'll come back to it in a minute. All right, so then after that, we get, say, strong non-farm payrolls, which is hawkish Fed, and therefore more yen shorting because there's more policy divergence and more yen downside. And then you get US CPI in the 9 handle for even more yen downside. Okay, and that was yen at its lowest, or dollar yen at nearly about to break 140, as this policy divergence was just very full-fledged. But then yen bottoms on July BOJ and ECB, which were on the same day. Okay, not exactly on the same day, but right, more or less around that time. And then the short covering began. And the earliest traders took profit on the policy divergence trade. And just as selling begets selling, buying or profit taking begets profit taking. And so we start to see yen bottom out and start to rise. Then July FOMC hits last week, and apparently the markets took a 75 basis point hike and killing forward guidance as less hawkish than expected. And that triggers call options gamma activity, or what we saw the way down with the mechanics of how options, and dealer hedging works, but just in reverse. And the yen jolts higher and dollar yen stair steps down. Then the day after FOMC, you get US GDP, which put US in technical recession. And so now there's literally a shift from inflation to recession in terms of market mentality, and then the yen surges again. Also, note that although the reason may be this, recession, this inflation to recession shift, and the yen, getting bought, those are two completely independent and coincidental things. Do not conflate that with yen equals a safe haven currency. It is not. It is being short covered, and the short cover happens to be something that is risk off, but that doesn't mean that people are flooding into the yen for safety. People are flooding out of a trade, and that they were shorting, they were betting against the yen. Okay, so after U.S. GDP, a few days ago, the yen surges again, but this time on no fundamental catalyst or no news. So why does that happen? Because fundamentals don't move prices in and of themselves. The only thing that moves prices in markets are buy and sell orders and flows of capital. Okay? Now, remember a few moments ago, I told you to keep that yen futures 75 level in mind, right? So that surge on no news, that most recent one, that was that 75 level broke into the upside. Now, why 75? What's the significance of that? There's 2 points of significance. First of all, that strike level, that strike price for options, had the most open interest in both yen puts and yen calls outstanding. But more importantly, the second reason that 75 is a key level is because 75 was the level where yen was trading during that insane week of June FOMC and June BOJ. Okay, so basically anyone who shorted the yen from there, they were doing well with that trade for a bit until this past Friday. When anyone who was short from that level or that period forward, they went from positive P&L to now breaking even and then potentially facing losses. And so there was a scramble for the exits to close short positions at that level because that's the level that they were opened. That's the significance of that 75 level on yen futures. So that's what's happening with yen right now. What's actually mechanically happening in markets. This is an actual explanation of price action for dollar yen, which I never ever hear clowny so-called strategists and talking heads on TV talk about, right? So that's what's going on with the price action of spot dollar yen. Now, dollar yen at this point, over the last 2 days, it's pretty much in its own state of being, okay? So it's not exactly following that policy divergence trade theme as closely anymore over the last 2 days because of forced position unwinds. And you can tell by looking at this chart of December 22 Eurodollar futures, okay, or front end rate futures, or Fed policy futures, if you will, versus the yen. Now, see how they used to move in lockstep, with Fed rate hikes getting priced in and out, right? Well, DEC 22 Eurodollar futures and yen futures, they've now just started to diverge. This is why I'm saying that the yen is facing its own idiosyncratic short squeeze, because the most crowded bet in global macro is being rushed to close out. So you can debate central bank policy and macro fundamentals all you want, but just know that markets will be markets regardless, and will move to the beat of capital flows in and out, not on stories. Speaking of which, I also want to flag this massive outsized current out-of-money yen call options position at 78.50 for December expiry. Now, notice how the upper end of the options open interest on yen futures is more or less around 1,500 contracts, right? For the largest size open interest, 1,500 to 2,000 contracts for a single strike price. The December 78.50 yen calls have over 20,000 contracts of open interest right now, or more than 10x the typical largest size, or 20x. Yen futures at the 78.50 level is approximately dollar yen at around 125 to 127, more or less, right? It's tough to tell exactly what it is, because these are just December futures and so on and so forth, but it's roughly around the 125 to 127 area. That's what 78.50 for yen futures is equivalent to. Yen futures and options, they are pretty large notional size exposure for futures contracts. Okay, they're 12.5 million yen per contract, or about $100,000 USD notional each contract. Okay, so someone or someone's is basically taking, a more than $2 billion notional sized bet that dollar yen will be at or below 127 or 125 by year end. Now, that's kind of aggressive, right? I don't know what the thesis for this trade is. I don't even know if it's an outright trade. I don't know if it's a hedge. It could very well be a hedge, right? But it could also very well be an outright bet of a full-on inflation to recession shift, or an increasingly dovish Fed market expectation shift, and sooner than Eurodollar and Fed funds futures are pricing for this Fed pivot to, going from rate hikes to rate cuts. Currently, that is sitting at January 2023. Right now, futures markets are pricing, the Fed funds futures markets are pricing the Fed to cut rates, hike rates, and until January they start cutting rates. So this is, a potential way of sidestepping the volatile mess that Eurodollar futures markets are currently in. Either way, that is a massive size position. We see what strike prices with, less than a tenth of the size can do to shove the spot dollar yen rate down in the past few days. So if that position gets gamma hammered, and that's a big if, but if it does go in the money, you can potentially see spot dollar yen gap down -2% or -3% in a single trading session, from say like 127 to 124, like in a 24-hour time period. Depending on market liquidity and various conditions, obviously, yeah, but it's very possible that could happen. So if you have some sort of like arbitrary like 125 long dollar yen limit order to buy or something like that, like because it's like a nice round number, something like that, I would avoid that, or I would at least be very aware that this options position at right around that strike price in massive size notional exists and is sitting out there. Okay, and it's expiry for December, so it's going to be out there for the rest of the year unless obviously they close it, but that got put on very recently. And speaking of flows of capital, there's also very likely corporate Japan repatriation taking place right now as well. Okay, so like currencies in general, they're not like other financial instruments that are subject to like investment capital flows only. Currencies are actually used for global commerce and other things, right? Notice over the last few days of this like yen strength that dollar yen falls the sharpest during Japan AM market hours. And again, that's also Japan retail flows also position long USD getting margin called as well. So it is also obviously investment capital flow driven, but it's also like various other things as well. Now, regarding the short euro yen trade that I mentioned for the Real Vision Daily Briefing. So yeah, I guess that's working, but obviously dollar yen short is outperforming on the short side right now. And it's because of these listed derivatives options positions. Those don't exist nearly to that size, and that, that size notional for the euro yen cross rate. But for the euro yen trade, this is a little bit longer in time horizon, or not really in time horizon per se, but in, I guess, situational horizon relative to the immediate, currently ongoing dollar yen collapse that's taking place. And it's actually a potentially interesting trading setup that way, because what that means is I can essentially short dollar yen currently, right? And scale out of that trade, and then subsequently switch into shorting euro yen in succession, which not only extends this long yen trade, if you will, but it allows for me to potentially get my principal out of the market and roll my gains to reduce or even like eliminate my short euro yen risk. If I can get my entire initial principal capital off the table and just play with house money, if it happens to play out that way, I mean, I'm playing risk free, right? That's a perfect scenario that rarely ever happens. I mentioned that the thesis behind shorting the euro against buying yen is due to policy convergence between ECB and BOJ, or the market's realization of policy convergence. Despite the ECB front-loading their rate hike, which was well priced in, the ECB also unveiled this TPI. That TPI, that yield spread control, that has to be exercised, or believed it will be exercised by the ECB by markets like imminently, in order for that fundamental policy convergence to be reflected in the euro yen cross rate. So that's why, it's not an immediate thing. But once markets start to potentially sniff out that there's going to be some unlimited buying of periphery sovereign bond yields or Italian bond yields, and they sense that the ECB might step in and print a whole bunch of euros in order to prevent that spread from widening, you're basically looking at an ECB that looks more like BOJ than it does the Fed. So key levels that I'm watching are, as I said, like certain options, open interest levels, and strike prices for expiry that's coming up in a few days. So that's basically yen futures at 76 and each handle thereafter. So 76, 77, 78. And if it gets there, you really need to watch that 78.50 on yen futures until the end of the year or until December expiry because of that massive, 20,000 contract open interest in calls. Spot dollar yen, like round levels like 130 or whatever, like, yeah, they matter, but not really. Not nearly as much as one would think. Okay. And then key dates that I'm watching and or possibly trading ahead of, because I'm, short-term directional. Things like US CPI next week, or any like US data that could shove markets away from recession and back to inflation focus, temporary or otherwise, or the other way around. And then central bank wise, the RBA, the Bank of England this week, Jackson Hole later this month, things like that, for policy divergence themes to play out. Those are potential yen like directional triggers. And then, of course, monthly options expiry and last trade date on the 5th of August, and which is very soon, and so on. All right. Now, the risk to being long the yen at the moment is Japan's current energy import situation that can quickly escalate into, crisis. I mean, I don't know how one would define crisis, but, Japan is buying spot LNG at market at ever higher prices. But as bad as the energy import situation is for Japan, Europe is in a considerably worse stance. In fact, into the back half of this year, I'd be hard-pressed to envision a scenario in which Japan is in a worse shape than Europe is for, procuring energy imports. So basically, whatever headwinds Japan has, like Europe will be worse. So shorting specifically the euro-yen cross rate basically has kind of a built-in hedge for that energy import risk. So there's also that sort of attractive part of it as well. Okay, but ultimately, why should you care? Why should you watch the yen? If you find yourself asking why you should care about watching the yen, the answer is because everybody else is. And capital that can and has and will move markets globally and cross-asset, they are directly exposed to it, or they're indirectly exposed to it, and therefore you are as well. That's why you need to watch it. All right, thanks a lot. See you next time.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.